Okay, and then I share with you the lecture notes. The lecture notes are already on Ilias for both Tübingen and Heilbronn, and they are divided in two parts. This is corporate finance lecture, and we'll have 60 questions mock exam next week on it. And as you know, these mock exams are without stress. Basically, let's see, this says recording. Okay, good. Basically, they are pass and fail. And finally, we have a CFA exam, one of those old exams from CFA, or very much a mock exam that represents CFA at the very end of the class that gives you your grade. Let's go to the first part of the lecture. And I got to share here. Share. Let me share the entire screen, and then guys at Tübingen, can you see cost of capital PowerPoint? If you want to mute yourself and say something, feel free.
Yes, we can see it.
Excellent.
We can see
Great.
your screen.
Okay, then let me get started. Essentially, a business pays cost of capital because they want our savings. We don't give them our savings for free. We demand the cost. We charge. And the other side of the coin is that investors receive a return. So the two lectures that you have for capital structure, for cost of capital, and for investor return looks at two sides of the same equation. Let's first look at cost of capital. If capital is short term, we call it working capital. And here we are focused on capital that is employed for more than one accounting period or more than 1 year, long-term capital. Long-term capital can be divided into long-term debt, borrowing money for a year or more, preferred stocks, and common stocks. The name preferred gives the image that these stockholders are somehow superior or preferred to common stockholders, common people. But it's actually the other way around. Common stockholders are the owners of a public corporation. They participate in the growth of the firm, and in takeovers, usually we go after them, or people who want to do a takeover go after common stocks, and the price of these common stocks go up. Preferred stocks are kind of halfway between common stocks and debt. They are like borrowing because they write in the contract what percentage they would give us as dividends. And we usually code them with that percentage, like 5% Siemens preferred stock. Common stock normally does not tell anything about dividends. Preferred stocks are like common stocks because if they don't pay their dividends, the firm does not go into default and we can't drag them into bankruptcy. Long-term debt has an obligatory interest. If they don't pay it, they are in default. But usually preferred stock dividend payments have some teeth. meaning that there might be some requirements that we should pay dividends on all preferred stocks before we pay any dividend on common stock. And usually firms pay these dividends on preferred stocks. Common stocks can be divided into two accounts, especially in accounting field, and we saw that in the last lecture. They are retained earnings, and this is part of the profit that the corporation retains or keeps. Earnings is, of course, profit, and it uses it for its growth as capital. A misconception is that retained earnings are free of cost of capital. No, they are not. They have an opportunity cost of capital because we could employ these retained earnings at some other corporation with the same risk as ours and earn a return. And then we have common stock, particularly when it is issued in an initial public offering. It's a new common stock, and usually we put the amount of money that we raise from new common stocks in a different account from the retained earnings. All right, so retained earnings do have cost because they have an opportunity cost, and that's often a CFA question. There is one very simple equation for calculating cost of capital in corporate finance. WACC, weighted average cost of capital, equals to the weight of debt in our capital structure times the interest of debt, which is K sub D, and that's cost of debt capital. But usually we calculate this cost of debt capital by looking at the yield of long-term debt that the corporation has. Usually consultants do this. They look at 10-year or 15-year debt and they look at their yield. In a minute, I do that calculation, but because these bonds sort of fluctuate in price in the bond market, the yield changes practically every day, so this cost of debt capital changes over time. Then we multiply it by 1 minus tax rate. Anytime you see 1 minus tax rate in finance or accounting, you read it as after tax. We multiply by tax rate, and that's our tax bill. And after tax, we multiply by 1 minus tax rate. The reason for that is debt tax shield. If debt has 10% interest, we deduct that 10%, like on a 1 million euro debt with 10% interest, we have 100,000 interest charge. We deduct that 100,000 before in our income statement before we get to our income before taxes. When you deduct this 100,000, you pay no taxes on 100,000. And if your tax bill is 40%, 40% of this 100,000 is 40,000. So 40,000 would be saved on taxes. So debt that costs you 100,000 per year really costs you 60,000 per year because government gives you a 40,000 saving and the other 60,000 you pay. Or a 10% interest becomes really 6% if you have a 40% tax rate. So you multiply 0.1 by 1 minus 0.4, and you get 0.6 as cost of debt capital. This does not happen with cost of equity or preferred stock. They are taxed and they are fully taxed, and they are not coming up from after-tax income. They're not they don't have a tax subsidy, I should say. This word marginal cost is important. Marginal cost means the cost of an additional debt on top of everything that you have. And so sometimes we talk about marginal taxes, the extra tax we pay for another euro of income. And sometimes we talk about marginal cost of debt, additional cost of debt. The reason for that is that the more the corporation borrows, they get closer to their debt capacity, and their default risk increases. So there might be a default risk premium on this interest, and their interest cost may go up. Here is the calculation that I promised you. A very typical question. A consultant goes and looks at a 15-year bond of a corporation. This bond has in its contract 12% semi-annual coupon. This never changes. The bond pays 12%. And the bond face value is always €1,000, $1,000. So the bond pays 12% of 1,000, and because it's semi-annual, it pays it twice a year. And so it pays €60 every 6 months. And this does not change. But if interest rates go lower and this bond pays 12%, this becomes a premium bond, and its price will go over 1,000. And here we have a premium bond because the price is 1,153.72. This price is an input that is available to us from our Bloomberg terminal, from the market for the bonds. And this price changes every day. And of course, it also changes if the riskiness of the corporation changes. If the corporation becomes more risky, then this bond price drops because it's only paying interest for its old riskiness, for the old default risk premium. Okay, so the consultant reads out this bond price of 1,153.72 and has the other data on the bond, 12% semi-annual 15-year bond, and then pulls out this financial calculator that you and I have. There are 4 inputs to enter here. N, or number of periods, is 30. This is a 15-year bond, but it's 30 6-month periods. Then we do the present value of this bond, which is its price. That has to be negative because this cash flow goes out of our pocket if we invest in this bond. So present value is minus 1,153.72. Then there is a payment every 6 months, and that payment is 60. So under PMT, you would enter 60. So annuity with a 60 payment at the end of the period. And then the future value of this bond is 1,000, because when the bond matures after 15 years, the corporation gives 1,000 back to you. And then we calculate interest per year. And of course, this is not per year, it's per period. And the calculator spits out 5%, and this is something you want to do on your calculators and make sure you get 5%. Then we multiply this 5% by 2. We don't compound, we simply multiply by 2. That's done in practice too. And we get 10% yield to maturity on this bond, or cost of capital. So we say the cost of capital for this corporation is proxied by yield to maturity of its 15-year bond, and that cost of capital for marginal debt, raising more debt capital now, is 10%. If you have questions, feel free to interrupt me at any time you like. So cost of capital is, go ahead.
Why don't we compound the 5%?
In practice, no one compounds, and in theory, in the classroom, we don't compound. CFA doesn't expect you to compound this. It's an approximation that is very close to the answer, but no one compounds.
Mm-hmm.
So I guess the answer to why is just tradition.
Mm-hmm. Okay.
Okay, yeah. Okay, so this is cost of debt capital, 10%. But as I said before, this saves you taxes. So if your tax rate is 40%, this becomes 10% times 1 minus 0.4, or 6% cost of debt capital. A related question is, what about flotation cost? Flotation cost means we got to pay a fat investment banker to sell these bonds to financial institutions, banks, insurance companies, and ultimately investors, individual investors. Flotation costs are negligible and they are often ignored in CFA and in practice. But if you don't have to ignore them, it is easy to add a certain percentage on top of this 10% as an approximation for flotation cost. They might be 0.1 or something quite negligible. Cost of preferred stock. This one is very easy. It goes back to high school. Preferred stocks are calculated, their costs are calculated based on perpetuity formula. Perpetuity formula says if you are getting the same amount every period forever, perpetuity means forever, then mathematically you calculate that by taking the amount that you take and dividing it by cost of interest or capital. So if you are getting 100 euros every period per period forever, there is actually a consul bond in UK that is a perpetuity. And if the cost of debt is 10%, we divide it by 0.1 and it becomes worth 1,000. We turn that formula around for calculating cost of preferred stock, and we say cost of capital on preferred stock, bringing it to the other side, equals to the dividend that it pays, assuming that it pays the same dividend forever. And yes, the contract says, for example, 5% forever. Divided by price of this preferred that changes every day in the stock market based on how well the company does or how bad it does. This problem says the price of a preferred happens to be $111.1 today. And this preferred pays $10 of dividends per year. What is the cost of this preferred capital to the corporation? KP equals $10 divided by $111.1. So the cost is 0.09 or 9% per year. Then we go to cost of equity. Cost of equity is difficult to calculate, to be precise and figure out what it is. For that reason, usually people calculate it 3 different ways and average these. Also, these methods are check and balance against each other. We want the methods to give us numbers that are relatively close to each other by a decimal point. So if one method gives us 8% and the other one gives us 18%, we know that we have done a mistake. All right, let's go over these methods. The first one is CAPM, Capital Asset Pricing Model. It won the Nobel Prize for 3 different finance professors. It's essentially a very useful and easy formula. It says KS, read it as cost of equity for Siemens, for example, equals KRF, the risk-free rate of return. Read it as the interest that German government pays for their shortest debt, or the interest that American government pays for their shortest debt, plus an amount that is in the parentheses, which is KM minus KRF. This is how much the stock market of that country paid more than the government paid on their short-term debt. KM is how much the stock market made us last year, and KRF is how much we earned interest if we loaned our money to German government. This is called risk premium for the stock market, because the stock market is riskier than DAX, is riskier than German government. They should pay us more return, and the return is KM minus KRF, additional return that the stock market had paid over the risk-free rate. This is multiplied by riskiness of Siemens measured by beta. beta has a very nice interpretation. If beta is 0, the firm has no risk. If beta is 1, the firm is as risky as the stock market. If beta is 2, the firm is twice as risky as the stock market. So, for example, if beta is 1.2, we put this firm is 1.2 times as risky as DAX, and we put a 1.2 for beta. Second method, this is named after Professor Gordon. It's called Gordon's growth model or dividend discount model. It basically says cost of a stock equals the dividend that the stock pays next period, D1, divided by price of the stock plus the growth rate of the company. We also use this formula for calculating the price of the stock. In that case, the price P0 goes to the other side and KS goes to the right-hand side. But this is how we use it when we are calculating cost of capital using it. The last method is quite easy. Investment bankers use this method based on judgment and experience in an industry, and they basically say in oil industry, cost of equity equals cost of debt of these oil firms plus a risk premium because equity is more risky than debt. This risk premium changes from industry to industry, and this risk premium should not be confused with the risk premium of a stock market. The risk premium of a stock market was KM minus KRF, and that's how much DAX pays more than the German government. The risk premium of Siemens is how much Siemens bonds pay more than, how much Siemens equity or stocks pay more than Siemens bonds. And that's frequently a CFA exam question asking about how we shouldn't confuse these two things. Okay, a typical problem is that we know for a country risk-free is 7%, risk premium of a stock market is 6%, and the firm's beta is 1.2. Then we plug these numbers into the CAPM formula, a very easy exercise, and this cost of capital for this company is 14.2%. For the same company, their dividend right now is $4.19. Their stock price from a Bloomberg terminal is $50. Their growth rate is 5%. In a minute, we calculate this growth rate also. But it's 5% here given. And we want to use dividend discount model to calculate the cost of capital of this company. The formula for dividend discount model requires dividend at period 1, next period's dividend, not this period. We assume that everything grows at this growth rate of 5%. My tasteless joke is that everything in the corporation, income, taxes, cost, grows at 5%. Even the corporate officers get 5% more fat next year. That's the tasteless joke, right? But going back to reality, dividend next period D1 is 5% more than D0, so $4.19 plus 1.05. We just treat this 5% like interest rate, and we multiply by 1.05 as we did in interest rates, and we get a dividend next period of $4.39995. Or 4.4 if you want to round it. So cost of equity capital is D1, which is 4.3995 divided by price of this stock, which today is $50, plus a growth rate of 5% or 13.8%. Then let's focus on calculating this growth rate. You basically say a company grows because it retains some of its profit. So if a company pays 65% of its profit as dividends out and keeps 35% of it, its growth would be 0.35. We are assuming the company doesn't waste this cash. Some of them do. Multiplied by return on equity. We are assuming that they would have the same return on equity that employ or this retained earnings that they employed as they had last period. And if this company has a return on equity of 15%, which we can simply calculate by taking their net income and dividing it by their total equity from the balance sheet, growth rate would be 5.25%, which can be rounded to 5%, and that's the number we used. Can the Gordon growth rate be applied if the growth is not constant? An assumption of Gordon growth rate is constant growth of 5% in this case forever. It really goes back that we can forecast the cash flows of the company for several years in the future, and after that we forecast a constant growth rate. It's like forecasting the weather. We can tell you what the weather is expected to be tomorrow, maybe a couple of more days, but if you ask me what's the weather in August, we just look at the average temperature in Germany. And here too in finance, we look at the growth rate. One way of doing this is to have cash flows or growth rates, particularly for a company that is in its startup or initial growth phase and grows much faster. For example, that growth rate G could be 30% for the first 3 periods, as you see on this line. And after that, it gets a stable at a growth rate of 6%. And this company pays $2 of dividends. Then you say, well, this $2 grows at 30% and becomes $2.60 at year 1, looking at my timeline. Then it grows again at 30% and becomes $3.38, multiplying 2.6 by 1.3. Then it grows by another 30% and becomes $4.39.4. And after that, it grows at a constant rate of 6%. So the beauty of the Gordon formula is that we can park it under year 3 in this timeline. Parking the Gordon formula under year 3, it becomes P3, or a stock price at year 3, equals dividend at year 4. We calculate that by multiplying 4.394 by 1.06, or growing it by 6%, not 30%. And it becomes 4.658. That goes as D4 on upstairs or nominator of the Gordon formula. So P3 equals D4 divided by this cost of capital that is given to us as 13%, 0.13, minus this growth rate, which in this problem is given as 6%, minus 0.06. And one way to remember this formula is that capital costs you 13%, but you get 6% of it by growth, and the rest of it costs you. So you go 13 minus 6%. And dividing these two numbers, we get $66.54 as cost of or value of this stock at year 3. Now we discount all these cash flows and bring them to present. The naught, which is $2, stays there. The 1, which is 2.6, gets divided by 1.13, 1 plus WACC, or 1 plus cost of capital, not by 1.3 or by the growth rate. So 2.6 divided by 1.13 gives us 2.3 as current cash flow. 3.38 coming to us 2 years from now gets divided by 1.13 raised to power 2, and it's worth $2.64.7 today. And present value of $4.39.4 coming to us 3 years from now, divided by 1.13 raised to power 3 is $3.045 of a dollar. And finally, $66.54 coming to us from Gordon's formula after 3 years, divided by 1.13 raised to power 3, discounted for 3 years, is worth $46.11.4 today. Now we add up these values and we get the stock price at time 0 of 54.107. There is a little point about adding that $2 or not, D not. That's if we purchase the stock ex dividend or post dividend. Post means after. If we buy the stock post dividend, we don't get the $2. The previous owner got it, so we don't add that $2. If they tell us that this is ex dividend, then we add the $2. Finally, the way that investment bankers use the magic is knowing this risk premium. Risk premiums for equity, we call it a puzzle. They are too high. Then the risk justifies, and investor bankers know this by a rule of thumb or seat of their pants by being in the industry all the time. The problem says it's 4%. The rest is very easy. You say cost of debt or yield, as we calculated before, was 10%, and so cost of equity is 4% more, so this is 14%. Then we go to the final answer. We say we use CAPM, and it told us that cost of equity was 14.2%. We used Gordon's formula, and Gordon told us that the cost of equity is not 14.2, but 13.8, so they're all approximate. We use cost of debt plus risk premium of equity, and that gave us 14%. We add these three numbers and divide them by 3, averaging, and we get 14% cost of equity on average. So this is pretty much how a consultant calculates cost of preferred stock, cost of debt, and cost of common stock. There is the issue of flotation cost for common stock. They are significant. Mercifully, common stock is not issued that often. One time when the company goes initial public offering for the first time, the private owners sell the company to public, they float common stock. And when they tell us initial public offering in a CFA exam or in real world, we have to calculate the flotation cost. Fortunately, it's easy. Another time is very rare, a company issues a seasoned equity. I usually do this by my hand in front of my nose, saying seasoned equity smells bad. Companies that issue seasoned equity go to their owners and beg for more money. Usually their stock price gets diluted and drops substantially. So it's very uncommon. It's better to issue debt or use retained earnings. It's kind of a last resort. But if it happens and the problem tells you that there is seasoned equity, then we have to calculate flotation cost. Let's do that. Here is a problem with flotation cost. It's very easy because we use a trick. The stock price is $50, but the flotation costs are 15%. We just say, look, we don't get the whole $50. 15% of it goes to the fat investment bankers, and we get 85% of it. So multiply $50 by 85%, and you get $42.50. So we pretend that the stock price is $42.50. After that, we are just using Gordon formula. Cost of equity after flotation cost is the dividend that it pays next period. This period's dividends are $4.19 times 1.05 to grow it by 5%, divided by 42.50, what we get from the stock price of 50 after the investment banker takes the rest, plus 5% growth rate, and it becomes 15.4%. Notice that this cost of equity after flotation cost is not 15% less than the cost of equity we got without flotation cost. we really have to go through this formula and reduce the price of a stock by 15%. Finally, we get to our formula for calculating WACC, or weighted average cost of capital. Well, average means we added these numbers up and took an average, but debt could be 90%, so we multiply that by 0.9. So weighted average means we gave weights to these different types of capital. Here the weights are given. Consultants calculate the weights by looking at actual amount of debt and equity that the firm has, either from accounting statements or approximating it from bonds and stocks that are out there. Here, they give us the weights. The weight of debt is 30%. The weight of preferred stocks is 10%, and the weight of capital equity is 60%. So 0.3 times 10% times 1 minus 4, which is 1 minus 0.4, which is the tax rate, which makes cost of debt 6%, times 0.3 is cost portion for the debt capital, 0.1 times 9% cost of preferred stock, plus 0.6 times 14% cost of equity. Here, notice that debt is always cheaper than equity because equity is riskier. So if we do a calculation, or if in a CFA exam, they give us cost of debt capital that is more than cost of equity, you don't make that choice. You choose alternative where cost of equity is more. And preferred stock here has 9% lower cost than cost of equity. That's usually true because it's halfway between debt and equity, and it's cheaper than equity. And this 9% seems to be less than 10%, but notice that debt saves us taxes and actually costs us 6%. So preferred stock costs more than debt and less than common stock. Doing this weighted average, we get 11.1% weighted average cost of capital. From now on, everything is discounted. Every cash flow is discounted by 11.1%. We treat it like an interest rate. This is the cost that we pay, and this is what investors earn. And all cash flows are discounted by WACC. I want to go to the next topic, and there are more slides here to sort of look at and prepare for answering CFA questions, and some of them are repeats, some of them give you extra material. But let me go to the second part of this corporate finance lecture, and as I said, we have a quiz on this next time. Second part is our return, what investors get as cash flows. So this is companies pay cost of capital, investors receive return. These are mirror images of each other. A typical lecture on this from Brilliant, Myers, and Allen, and of course, if you look at this lecture notes, they have Brilliant, Myers, and Allen as a source. That's a good source to look at, but the slides could be enough, and taking the quizzes could be enough to do well in CFA. And also, Schweizer notes are useful. They cost a lot of money. And years ago, they gave their notes to me to use it with a live class. And you guys are live, so it's allowed. And some of the material, not all of it. I also look at Brilliant, Myers, and Brigham and Houston is an easier undergraduate book that if you want, you can refer to. But anyways, Brilliant, Myers, and Allen have this exam. It's a very simple exam. It says the forecasted cash flow cost of a building is 350 million euros. And you forecast that after a year of building, you can sell this building for 400 million euros. Sale price in year one. And you forecast your estimated opportunity cost of capital, looking at the riskiness of building business. If you gave this 350 million to someone else, they would give you 7%. Then you go and discount these future cash flows by opportunity cost of capital. So 400 million that you receive in year one divided by 1.07 has a present value of 374. And net present value is minus 350 that goes today out of your pocket, plus 374, which is the present value of that 400, and that 7% accounts for risk because it has a risk premium embedded in it. So these two numbers can be compared to each other, and the difference is 24 million. Net present value could be understood as wealth. You get wealthier if you take this building project by 24 million euros. And of course, you can calculate this as a very easy calculation with your calculator, financial calculator, and those keys are also written here for HP12C. But please practice with it with your own financial calculator. So the formula for net present value is very simple, comes to us from high school. It says present value of future cash flows minus current required investment, which is usually a negative cash flow going out of our pocket. Then we get to a very easy net present value rule. If net present value is positive, we get wealthier taking this project. If it's zero, it adds nothing to our wealth, so we shouldn't take it. And if it's negative, it destroys wealth, and that's not a good project to take. Let's look at two projects, an example again from Brilliant Myers and Allen. The first project, Project L, requires 100 million of investment at time zero today. After a year, pays 10 million. You could think of this as income statement, net income plus depreciation. This is basically the cash flow you get. You add the depreciation because depreciation is a non-cash cost, and that came in accounting discussions too. After year two, treating the project like a cash machine, it spits out 60 million. After year three, the project spits out 80 million, and the machine goes kaput. Kaput in English sort of means a big explosion, and the machine goes away. But this 80 is after all cleanup costs, and they have nothing left. The second project is the same minus 100 million investment, 70 period one, 50 period two, and 20 period three. Now we calculate the net present value of these two projects. So you write down the cash flows, minus 100 is worth minus 100, 10 is worth 9.09 after you discount it at the cost of capital, which is given as 10% in this problem. You divide it by 1.1. And 60 becomes 49.59 as present value, and 80 becomes 60.11. You add up these present values, and the project is worth 18.79. I wrote it as dollars, and that adds to your wealth. So net present value is positive for project S. We calculate net present value with the financial calculator, and the keys are given here. Please practice with them. And I have the keys for HP12C also. Then we calculate a net present value profile. Net present value profile means that you are going to change the cost of capital to different amounts. Let's start from 0, go to 5%, 10%, 15%, and 20%. And if the cost of capital changes like that, what happens to net present value of this company? This is very easy to do with a financial calculator because you enter all the numbers in, and the only thing you change is interest per year. You put 0, then you put 5, then you put 10. Of course, at the cost of capital of 0, we simply add these cash flows. Net present value of project L is $50 at the cost of capital of 0. Project S is $40. At 5% cost of capital, net present value goes down to 33%. And you see that as the cost of capital goes up, the project's net present value becomes lower, and at some cost of capital, it becomes negative at 20% here for project L. Now we want to do the concept of internal rate of return. Basically, the idea is at what cost of capital this project generates 0 net present value. Going back at the profile that we had up there, that's something between 15 and 20%. At 15%, the net present value of project L was 7, and at 20%, it was -4. So somewhere between 15 and 20. I know the answer is 18, but somewhere there. So far, we know the net present value becomes 0. If we wanted to write this as a formula, internal rate of return is an unknown interest rate that if we discount at that rate all the cash flows and we add up the present value of these cash flows, we get a net present value of 0. We can understand this concept with the graph a lot better. There are two curves here. One is internal rate of return with the profile of project L, and that's the blue graph. And then internal rate of return for project S is that black graph. And on this, two curves hit the horizontal axis for project L at 18.1%, and that's internal rate of return being 0, because if you hit the horizontal axis, your net present value or the value of the vertical axis is 0. And for project S, the graph S hits at 23.6%. The other interesting fact is that these two graphs cross each other at a point that we call crossover point. And this crossover point is important, and sometimes CFA asks us questions about. Here visually you see it, and it happens at 8.7%. And later on we calculate this by hand, what the value of this cross point is, but of course we can also read it from the graph. Finding the cross point, this is the later on. It says, look at the cash flow differences between two projects. It doesn't matter which project you deduct from which one, L minus S or S minus L. But usually we like it when the initial cash flow is negative because it makes sense that we are paying to invest in a project. And then do an IRR for these differences, and you would get that 8.68% or 8.7%. And of course, IRR or internal rate of return is something we can do with our calculators. All times very old times, before we had calculators, definitely before we had Excel, we used to do this by hand, and we would draw these curves and look at where they cross and where they hit and calculate IRR with trial and error or with curves. Okay, IRR generally is used in practice. If we were just in the classroom, academic life, they would tell us not to use IRR because sometimes it lies to you. Sometimes it chooses the wrong project. And CFA goes over some of these pitfalls of IRR that are well known. And I'm mentioning some of them here. I should also mention the rule for IRR, but it's something that many of you know from high school and other finance classes. If internal rate of return of a project is more than WACC, it means it costs you 10% to do this project, but the project gives you 12%, then we take it. If IRR is less than WACC, it says it costs us 10% to do the project, but the project gives us 8%, then we don't do that project. And of course, net present value had net present value positive rule. The problem with IRR is that it assumes that we reinvest at this IRR. And especially it gives us the wrong answer if we have two projects and we can only take one of them. So these projects are not independent. So if we have two independent projects and both of them have internal rate of returns that is more than their WACC, we can take both and there would be no problem. But if IRR is used to pick a project, it could lie to us. It's better to use net present value. And there are many examples in the literature. Here is one of them. It says calculate the net present value of the following project. You pay 4,000 to do the project, then the project gives you 2,000 after 1 year and 4,000 after 2 years. Net present value of this project is 0, but IRR net present value of this project is 0 according to the definition at an unknown IRR. And when we solve for this internal rate of return, this is the formula that we got to solve. And of course, you and I use the financial calculator Excel, and we get an IRR of 28.8% for this project. When we draw this project, when we do a profile for it by doing different cost of capital and calculating its net present value, we see that net present value of this project is positive when cost of capital is less than 28% and is negative when cost of capital is more than 20%. Okay, here is another example. In this example, at time 0, we have 1,000 euros. At time 1, we have minus 3,600 euros. At time 2, we have a cash flow of 4,320 euros. At time 3, we have a cash flow of minus 1,728. This is a classic example, and when we calculate IRR for this, we get 20%. But if you calculate net present value, this at 10%, this project has a negative net present value of 75 cents. And of course, net present value is accurate. This is a project you should not take at 10% WACC. But IRR says that, hey, the project generates you 20% and WACC is 10%, so it generates you a lot more than cost of capital, and says take it. So this is one place where internal rate of return lies to us. Again, if we were just in academic life, we would throw IRR in the garbage, but when we go to the industry, they insist on it because it makes sense to say this project is making 12% and its cost of capital is 10%. And this is a much easier way for practitioners to talk about how much money they make from a project. I did an Excel printout on this too, and of course in CFA you can't use the computer or Excel, but a lot of us in practice use Excel, so if you want to try this, you could. It's in the lecture notes. There is a little graph of this, how the IRR changes and the profile and net present value of this project changes with discount rate. The second pitfall, it's again another counterexample. In that counterexample, we spend 1,000 today for a project. After one period, it makes us 800. After another period, it makes us 150, and it continues making us 150 for until period 5, and then at period 6, it has a cost of 150 for cleanup and termination of this project. Net present value of this project is 0, both at minus 50% and at 15.2%. Means it has two IRRs, minus 50 and plus 15.2. Net present value of it is 74.86. So one headache with IRR is we can have multiple answers, and especially if we get that minus 50%, we would not take this project because its internal rate of return is negative. There is also an Excel printout for doing this, but as I said, this is just for your practice if you're curious. And here is the investment profile or net present value profile of this example in pitfall number 2. And as you see, the red curve of net present value hits 0 at 2 places, at IRR equal minus 50% and at IRR equal 15.2%, the two discount rates on the horizontal axis. Here is another project. At time 0, we pay 800 million. Cost of capital or WACC is 10%. At time 1, we make 5,000 million. And at time 2, we have 5 billion or minus 5,000. And this is a cost of cleanup of, let's say, this oil rig. And if we enter these cash flows in the cash flow register of our calculator, and we put an interest per year of 10%, we get a net present value of 386.78. This project again has two IRRs, and that's a headache, and that's a problem with internal rate of return. It hits at 20% and at 400% IRRs, 25% and 400%, as you can see from this net present value profile drawing. And of course, you can enter this into your calculator. Our calculators allow a guess, and this guess prevents multiple answers. So you can store a guess for IRR, for example, 10%, which is the cost of capital, and then it only gives you this IRR of 25%. doesn't give you two answers. Pitfall 3. There are two projects, Project E and Project F. Project E cost 10,000 euros to start. After a year, it pays us 20,000. Internal rate of return for this project is 100%. Net present value of it at 10%. WACC is 8,182. That comma being English comma, so it's 8,000. Project F cost us 20,000 today. After a year, it pays us 35,000, and its internal rate of return is 75%, but its net present value is 11,818. Net present value says Project F is better, and indeed Project F is better. It makes us wealthier. But internal rate of return says that Project E is better because it gives us 100% return, but it makes us less wealthy. The problem here is that the Project F is twice the investment of Project E, and if we can take Project E twice, then yes, it's superior. But we would miss out on that extra 10,000 investment if we don't take Project F. And although the second 10,000 doesn't earn us 100%, but adds wealth, so net present value says take Project F, but internal rate of return says take Project E. So that's, again, another pitfall of using internal rate of return. So in short, there are well-known pitfalls of using internal return. We should know them. CFA asks us about it. If they ask us what's the best method, we always say net present value positive. And of course, that's a very easy method too. Pitfall 4, term structure assumption. We assume that discount rates are stable during the term of the project, especially for internal rate of return. But for net present value, we can put different discount rates for different periods of time and different WACCs and calculate it precisely. This assumption implies that all funds are reinvested at the rate of internal rate of return, which stays the same, which stays constant for the life of the project. This is a false assumption. With net present value, we simply use a different appropriate discount rate for a different period. There are a number of other definitions for return that CFA tends to ask questions, and these different definitions are a matter of knowing the terminology. And one is holding period return or total return. So they would ask you what's a holding period return or what's a total period return of a project. It's the percentage increase in the value of investment over the period that the investment is held. So if an investment is held for 2.5 years, and after 2.5 years, it gives you 1,100, and today you give 1,000, you simply say 1,100 minus 1,000 divided by 1,000 initial investment, 10% return over 2.5 years. Usually we do our interest rates or WACCs yearly, but for holding period return, we are doing our WACCs over the entire period. Sometimes the securities have cash flows in the middle. For example, a stock pays dividends. So how do we calculate holding period return for a security that has interim cash flows? Here is an example. What is the holding period return for a stock that is purchased at $30 and sold at $33 10 months later. We hold it for 10 months. Given that after 6 months, the stock has paid 50 cents of dividends. You say holding period return is C2, what you sell the stock for, which is 33, plus the dividend that it pays, which is 50 cents, so 33.5, C2 plus C1, and then you divide that by C0, which is how much you paid to buy the stock, and that was 30. Then you subtract 1. There are two formulas here that are equivalent. You could do C2 plus C1 divided by C0 minus 1, or you could do C2 minus C0 plus C1 divided by C0. Basically, we are dividing both sides by C0 and getting that 1. Okay, and this gives you 0.1167 or 11.67% holding period return. This comes directly from a CFA exam question that asks you exactly to calculate this. So I took it from there. And holding period return is something that you and I are not used to. They are doing this for 10 months, not for a year. So it says the investors, an apostrophe is missing there. 10-month holding period return is 11.67%. Note that this method ignores the effect of time value of money on the dividends. We just enter the amount that we receive after 6 months. We don't discount it for the 6 months. Again, that's convention. That's how it's done, and that's how you would do it in the CFA exam. The next type of return that is calculated in finance is money-weighted rate of return of a portfolio. This is really another name for IRR, internal rate of return, and we did quite a few examples there. So if the CFA exam tells you money-weighted rate of return, they mean IRR. Here is another example from old CFA exams. It says a share is purchased for $100 at T0 right now. Another share is purchased at $120 at T1 a year later. At T2, 2 years later, the shares are both sold at $130 each. The stock pays $2 of dividends at the end of each year. What is the money-weighted rate of return? They really want us to calculate IRR. For this kind of problems, even you have a short period of 1.5 minutes, don't save time by not drawing a timeline. Please draw a timeline. It makes the difference between the right answer and the wrong answer. At the timeline, time 0, I put minus 100 because 100 goes out of my pocket buying the first stock. At time 1, 120 goes out of my wallet because I purchased the second stock. And $2 comes to my pocket because the first stock gives me $2 of dividends. At time 2, 260 goes into my pocket because each stock is sold at 130. So multiply by 2, you get 260. Plus, I get $4 of dividends, $2 for each stock that I own. 2 times 2 equals 4. Now the problem becomes very easy. I want to calculate internal rate of return for these 3 cash flows. I enter the cash flows in the cash flow register of my calculator, and I push internal rate of return, and it gives me 13.86%. Here are the instructions for TI 2+, and of course, you could also do it with HP. Next concept is time-weighted rate of return. Again, this is a name we gotta know if we go to the CFA exam. Time-weighted rate of return is another word for geometric mean return. That has to do with compounding. And when we are compounding, we are calculating a geometric average. This is really the best way to calculate the return of a project. This is a better measure of performance than money-weighted rate of return, as it accurately accounts for the timing of our cash flows. Let's do one. Same old problem that we had. The stock was purchased at 100, paid $2 of dividend, went to 120 and we bought one more, and then we sold them both at 130 and received $4 of dividends. Then this becomes 122 divided by 100 minus 1, or 22% in 1 year. And in 1 year, the first share value has increased to 120 and it paid a dividend of 2. So the return is 122. And if we divide that with how much we invested, which is 100, we get 22% return for the first stock. This is a holding period return for 1 year. Then we calculate a holding period return for the following year. In the following year, we have 264 returned to us, and our investment was 240. Why 240? Because we had two stocks that were each worth 120 at year 1. The one that we purchased, previous one, and went to a price of 120, you could assume that this is reinvested. Rather than getting your 120, you kept this investment and you bought another for 120. So the capital you have stuck in year 1 is $240. And after a year, in year 2, you get $264 for this investment of 240. 264 divided by 240 minus 1 gives you 10% return. So now see what happens. Year 1, you have 22% return. Year 2, you have 10% return. You want to average these. You're not doing a simple math average of 10 plus 22 equals 32 divided by 2 equals 16, but you are compounding. You're saying which interest rate applied for 2 years would be equivalent of making 22% year 1 and 10% year 2. In other words, 1 plus x, in other words, 1 plus what interest rate compounded twice, raised to power 2, gives us 1.22. 1 year gives us 22%, multiplied by next year 10%, multiplied by 1.1. Solving this equation, you get a geometric return of 15.85%. So if you look at this investment, it makes you 15.85% return per year using compounding or precise interest rate that this project pays you. Treasury bill bank discount yield, another type of return calculation. Treasury bills are very much specific to US. When we say T-bill or Treasury bill, we mean that we have loaned our money to US government for less than a year. Money managers across the world do this, and of course CFA is American-based, so it exams us on some American terminology, and of course we got to know Treasury bills. US Treasury bills are issued as discount bonds. Bonds are usually 1,000 euros. Discount bond means they give it to you at less than 1,000. For example, 900 $90. And once the treasury bill matures, they give you 1,000. So you pay less than 1,000 and you buy it now, and later you get 1,000. And of course, the extra money is the interest on this loan to U.S. government. U.S. Treasury bills are issued as a discount bond. For example, a Treasury bill that has a face value of $1 million and 270 days until maturity sells for $950,000, less than the million. And the extra 50,000 after 270 days is the interest that it pays you. That is, T-bill price reflects a discount of 50,000 from the face value. This discount is an interest income that you receive. The bank discount yield is calculated by dividing the interest that is earned, this 50,000, by the face value of the discount bond. Face value is always $1 million, the whole number. Then the result is annualized, made yearly. So if this treasury bills is for 270 days, to annualize it, we multiply it by 360 days and divide it by maturity in days, which is 270. We make it yearly because interest rates are usually coded yearly. So in this case, the bank discount yield, or RBD for bank discount, is D divided by F. D is the discount amount, which was $50,000, divided by F, which is face value, which was $1 million, multiplied by 360 days per year. We usually take 360 in these examples, not 365 or 364, divided by 270, which is the maturity of this instrument in days. And that gives us 0.0667 or 6.67. So we say bank discount yield of this treasury bill is 6.67%. Interpretation. BDY is a conventional, traditional method and is not academically correct. But again, just like that question that a classmate had before, why we don't, count for the timing of this dividend, or why don't we properly compound? We go by traditions too in finance. What they do in the industry is what we do. And so BDY is conventional, it's done in the industry, particularly in US, but it's not academically correct. One should divide the interest earned of 50,000 by the initial investment of 950,000 to be academically correct. You calculate return on your investment of 950 and you make 50. The result must be analyzed by multiplying by 365 divided by maturity in days instead of 360, but 360 is conventional, and we do a 360 in CFA exams. Annualizing assumes that we can reinvest in treasury bills at the same interest for the rest of the period to make it a year, and that assumption is sometimes violated because the interest rate on these treasury bills change a lot over time. Treasury bill holding period yield, HPY. Holding period rate equals ending value minus initial value plus the payout divided by initial value. The ending value of this treasury bill is $1 million. Initial value is what we invest, and we invest $950,000 because this is discounted by 50,000, divided by 950,000 that we invest, and the holding period return for this same treasury is 5.26. Notice that this 5.26 is different from that 6.67, which was bank discount yield. So these yields are different. Treasury bill effective annual yield. CFA exam would ask you, what's the effective annual yield? The effective annual yield analyzes the holding period yield accurately based on 365 days and takes into account interest earned on interest and does proper compounding. So effective annual yield is the academically correct way and the best way to compare investments. EAY, or effective annual yield, equals 1 plus holding period yield raised to power 365 divided by number of days that are the maturities of this instrument, written as T here, and then subtracting a 1 to get the interest. So 1 plus 0.0526, because holding period yield for this problem was 5.26%. Raised to power 365 divided by 270 minus 1 is 7.17%, and that's the accurate return on this financial investment. This yield is higher than the holding period yield for 270 days because it is for 365 days, and of course in 270 days we make less money because they have our money for a shorter period of time and pay less interest. It is also higher than the bank discount rate because that method uses the higher face value, which is 1 million, not what we invest, which is 950,000. Treasury bill money market yield, or the CD equivalent yield. Here, Treasury bill yield is calculated in a similar way as the money market or CD rate that pay interest for 360 days. So RMM, or return on money market, is holding period yield, and then we analyze that 360 divided by this 270, which is the maturity. That is the end value minus the initial value plus the payout or anything in the middle, divided by initial value and then annualized 360 divided by 270. This equals to 1 million that we get at the end minus 950,000 that we pay in the beginning to invest in this investment, divided by our 950,000 investment, annualized or multiplied by 360 divided by 270, and that gives us 7.02%. There is a bunch of formulas that allows you to convert these different returns to each other, and they are summarized in this slide. I would like to stop here for 5-6 minutes of questions, comments. As I said before, there is a quiz of 60 questions, 1.5 minutes each. It's low stress. I get some questions on the chat. Let me read them. Daniel says, what is the term of the risk-free rate? That's a very good question. Should it reflect the long term of equity investment? This is a bit controversial. My own opinion on it is that risk-free rate should be for shortest government bond, shortest bond that a German government has or US government has. And my reason for that is that the shortest bond does not have maturity risk. Maturity risk means that if you have a longer period on a bond, its maturity is longer, all kind of events can happen in the marketplace like corona, other things, and then that risk is embedded in the yield of the bond. But some professors say that if you have a 2-year investment, you got to take a 2-year government bond and use that as risk-free benchmark. And some money managers do that. This controversy doesn't come in CFA exams, but as I said, if you want to take my word for it, my word is use the shortest government bond because it does not have maturity risk premium. It does not have inflation risk premium. It basically is risk-free. But again, I have to admit that some professors say go with the duration of the investment and take a government bond for that duration. And for some calculations, that's more appropriate. And for some calculations, when being risk-free is the main thing, that's not appropriate. Will the lecture recording be uploaded on Ilias? I probably put it both on Ilias and on YouTube, which I've done in the past. I believe so far I haven't used anything proprietary, anything that CFA owns. Usually, as I said, I have some questions that come from Schweizer and come in your quizzes that I can't share on YouTube. So I think I'm okay. And of course, if you don't want your face to appear on YouTube, let me know and we can delete it or try to do something. I think the only one who had the camera on is Tobias. Tobias, do you mind if your face appears on YouTube?
I don't mind, no.
Good. I don't mind either, but yeah.
Yeah.
I'm ugly anyways. Yeah.
Good that you used, but yes.
Some students are kind to me. Other questions, comments? Okay, then have a wonderful evening. The weather is good. I have posted the lectures, both lectures on Ilias. I would give you the quiz next week at 4:45, 60 questions. And right after that, I would give you all the answers and all the past questions that I have on this topic. And then we move to portfolio theory. Take care of yourself. Bye-bye. Thanks, guys.
Hi, are you still there?